Today, we will talk about days sales of inventory, DSI, a financial ratio that indicates the average time in days that a company takes to turn its inventory into sales. The days sales of inventory is a financial ratio that indicates the average time in days that a company takes to turn its inventory, including goods that are a work in progress, into sales. DSI is also known as the average age of inventory, days inventory outstanding, DIO, days in inventory, D2, days sales in inventory, or days inventory, and is interpreted in multiple ways. Indicating the liquidity of the inventory, the figure represents how many days a company's current stock of inventory will last. Generally, a lower DSI is preferred as it indicates a shorter duration to clear off the inventory, though the average DSI varies from one industry to another. To manufacture a saleable product, a company needs raw material and other resources which form the inventory and come at a cost. Additionally, there is a cost linked to the manufacturing of the saleable product using the inventory, which is represented by the cost of goods sold. This financial ratio is calculated based on the average value of the inventory and cost of goods sold during a given period. The numerator figure represents the valuation of the inventory, and the denominator, cost of sales/number of days, represents the average per day cost being spent by the company for manufacturing a saleable product. The net factor gives the average number of days taken by the company to clear the inventory it possesses. Two different versions of the DSI formula can be used depending upon the accounting practices. In the first version, the average inventory amount is taken as the figure reported at the end of the accounting period, representing DSI value as of the mentioned date. In another version, the average value of start date inventory and end date inventory is taken, and the resulting figure represents DSI value during that particular period. Therefore, it is vital for the company to calculate DSI value with the COGS figure and inventory data based on which version of this ratio is used. Since DSI indicates the duration of time a company's cash is tied up in its inventory, a smaller value of DSI is preferred. A smaller number indicates that a company is more efficiently and frequently selling off its inventory, which means rapid turnover leading to the potential for higher profits. On the other hand, a large DSI value indicates that the company may be struggling with obsolete, high-volume inventory and may have invested too much into the same. It is also possible that the company may be retaining high inventory levels in order to achieve high order fulfillment rates, such as in anticipation of bumper sales during an upcoming holiday season. However, it is important to take into account the DSI value cautiously and compare it among industry peer companies, as DSI tends to vary greatly among industries depending on various factors like product type and business model. It's important to note that a high DSI value may be preferred at times depending on the market dynamics. If a short supply is expected for a particular product in the next quarter, a business may be better off holding on to its inventory and then selling it later for a much higher price, thus leading to improved profits in the long run. Careful inventory management is required to strike a balance between optimal inventory levels and market demand. A similar ratio related to DSI is inventory turnover, which refers to the number of times a company is able to sell or use its inventory over the course of a particular time period, such as quarterly or annually. Inventory turnover is calculated as the cost of goods sold divided by average inventory. DSI is an inverse of inventory turnover over a given period. A higher inventory turnover ratio is generally better for a company, as it indicates a greater generation of sales. DSI is the first part of the three-part cash conversion cycle, which represents the overall process of turning raw materials into realizable cash from sales. Understanding DSI and inventory turnover can help investors assess a company's inventory management and efficiency. DSI and inventory turnover ratio can help investors to know whether a company can effectively manage its inventory when compared to competitors. A good DSI is somewhere between 30 and 60 days, but this varies by industry, company size, and other factors. Managing inventory levels is vital for most businesses, and DSI provides a more accurate picture of a company's inventory management and overall efficiency. DSI can also indicate how a company's stock may perform in the market, with high DSI often not boding well for a company's overall productivity and performance. Here are 3 key takeaways. 1. Days sales of inventory, DSI, is the average number of days it takes for a firm to sell off inventory. 2. DSI is a metric that analysts use to determine the efficiency of sales. 3. A high DSI can indicate that a firm is not properly managing its inventory or that it has inventory that is difficult to sell. Hope this would help. Thanks for watching.